Hey everyone, and welcome. Today, we're diving into a challenge that pretty much every finance pro faces: how to make sense of absolutely massive datasets. We're going to talk about a super powerful technique called Principal Component Analysis, or PCA for short. It's all about finding the true drivers hidden deep inside your financial data. So let's get into how you can turn all that data chaos into clear, actionable insights. Does this feel a little too familiar? You're collecting more data than ever before, right? Customer details, GL accounts, transaction logs. But are you actually getting more insight? Or, does it just feel like you're drowning in a sea of numbers? Yeah, if you're nodding along right now, you've definitely seen the symptoms. All that extra data, it just creates noise, making it so hard to see what's actually important. And you get redundancy, right? Where you've got multiple columns basically telling you the exact same thing. This is what leads to forecasting models that overfit, and those dashboards that are so cluttered they end up confusing people instead of actually helping. So how do we fix this mess? Well, the answer is this idea called dimensionality reduction. It's all about finding that one clear, strong signal that's hiding inside all of that noise. Now, the key word here is compressing. And look, this is not about just randomly deleting columns, okay? Dimensionality reduction is about smartly reorganizing your information into a smaller, much cleaner, and way more useful set of new dimensions. So there are basically two main ways to pull this off. On one side, you have feature selection, which is kind of like picking the absolute best players from your current team of columns. On the other side, there's feature extraction, which is all about creating brand new, super-powered features by mashing the original ones together. And that is exactly where PCA comes in. PCA is a feature extraction technique. See, its whole job is to look at all your variables and mathematically find that hidden structure, those underlying patterns that tie everything together. Okay, but how does it actually do that? Let's try to build some intuition here for how PCA thinks, using an example I bet you'll recognize. All right, so just imagine you've got a typical customer data set. I mean, we're not talking a handful of variables. You're probably looking at 30, 50, maybe even more columns for every single customer. And these are the variables you see every single day, right? Loan term, interest rate, credit score, loan amount, and on and on. And a lot of these things are connected. A lower credit score, that often goes hand in hand with a higher interest rate. They move together. And this gets us to the real magic of PCA. What if all those individual columns aren't telling 30 different stories? What if they're all just different angles of like 3 or 4 main stories? That's what PCA does. It finds those stories. So it might look at your data and go, hey, credit score, income, loan to value. That's all really just one thing, a creditworthiness factor. And maybe term, loan amount, and rate all combine into a product structure factor. And just like that, 30 confusing variables become 3 or 4 super clear business ideas. Much better, right? All right, so that's the theory. Let's talk about how this actually works in the real world. Like, where can you really use PCA to solve actual problems in finance and accounting? Okay, let's kick it off with a classic FP&A headache, trying to explain what's driving your revenue changes every single month. You know the drill. Before PCA, you're trying to juggle, 20 different drivers, units, pricing, promos, seasonality? It's a total mess. But after you run PCA, you can boil all that chaos down to just 3 or 4 main components. You might call them a volume driver, a pricing driver, and maybe something like a macro pressure driver. All of a sudden, your variance analysis is incredibly clear. All right, let's grab another one. Portfolio risk analysis. Especially if you're in lending or leasing, this is a perfect fit for PCA. Just think about it. You can take a data set with, say, 50+ customer features and shrink it down into just a few core risk axes. So you might end up with a credit risk axis, a product structure axis, and a behavioral axis. This makes everything, from modeling to customer segmentation, way, way simpler and a lot more solid. Okay, a question I get all the time is, that's cool, but how do I even know what these new things mean? And the good news is, the output you get from PCA is actually really easy to understand. You get this thing called component loadings, which is really just a simple table like this. It just shows you how strongly each of your original variables connects to the new components. So if you look here, you can see APR and balance have these high positive scores for PC1, but term has a high negative score. That tells you that PC1 is probably a financing intensity factor. See? It's that easy to read. And listen, it doesn't stop there. The applications are huge. You can use PCA to hunt for weird anomalies in huge datasets for fraud detection. You can figure out which GL accounts always move together. You can prep your data for machine learning models, analyze cost center patterns. I mean, it is an incredibly versatile tool. Okay, so let's wrap this up. What's the big takeaway? It's really about making a huge shift from total chaos and complexity to real clarity and structure. Look, at the end of the day, PCA really belongs in every modern finance team's toolkit. Why? Because it lets you compress all that complexity and it reveals the hidden relationships in your data that you never would have seen otherwise. It helps you spot patterns, it improves your models, it beefs up your risk analysis. Basically, it helps you make decisions based on the real drivers, not just the surface level noise. I just want to leave you with this final thought. In a world where, let's be honest, we're all kind of drowning in data, think of PCA as this special lens. It's the lens that lets you filter out all that noise, find the actual signal, and finally, turn all that chaos into clear, actionable structure.